Good afternoon to everybody on the East Coast and good morning to people on the West Coast. In the Talmud, there's an expression, potchim b'chvod achsanya. You always begin remarks with expressing some form of recognition and honor to the host.
Yeah.
The host here is the Jewish National Fund, and I've said this a million times and I'll never get tired. It's the greatest honor in the world to be a financial advisor to what I call the State of Israel, and money that so helps build and maintain the State of Israel. Matt knows that I take my job way too seriously, but especially when it comes to money that belongs to the kinds of causes that the Jewish National Fund continues to support. And I want to make just an extension of that to all of you. Anybody that supports the Jewish National Fund is family. And whether you're a client or you're not a client, I want you to feel that from this moment on, the lines of communication are open. If we don't get to all your questions, if you have some personal things you'd like to run by me, Matt is going to give you my contact information on request. Never feel hesitant to reach out and speak to me. So this has been a very, very challenging 8 weeks for all of us. And sadly, the market's been the least of it. But nonetheless, money's important. People need it. People rely on it. It's a cause of worry and anxiety for a lot of people, especially those that are retired. And in my career on Wall Street, this is now the third major crisis that I am guiding my clients through. Each one is different in some way. The catalysts are different, the variables are different, but in many, many ways, they're all exactly the same. The fear, the anxiety, the uncertainty, the impulse to do something, the pendulum swinging from greed to fear, back to greed, over and over and over, causes investors to continue to make the same mistakes they've made since the beginning of time. In 2008, when the world was crashing, I quickly realized that I was not prepared. In my years of college and all the studying that I had done about graphs and charts and inflation and earnings and returns on equity, I was not prepared to deal with clients that were rational only a week before becoming completely irrational when they were gripped with fear and anxiety. And the statistics show that most investors don't make it through a cycle without causing some financial harm to themselves, which they go on to later regret. The 2008 statistic is quite abysmal. Trillions of dollars left the markets in the 08-09 crisis, only to return 6-7 years later when the market was reaching all-time highs. And as always, the smaller investors lost out. Bill, just throw up the Dell bar for a second. There it is. I just want you to look at this chart for a second. And this chart is what keeps me up at night. This chart is why I go to work every day. What this chart shows, let's just focus on the 30-year, that over a 30-year period, the S&P 500 returns slightly above 10% on average, while the average investor only earns 4% during that same period. So these are investors in the S&P 500. These are not investors in real estate or bonds. Yet, they are earning 60% less than the return of the market. As a metaphor, this would be like saying the El Al flight to Israel flew at 40,000 feet, but the passengers only flew at 10,000 feet. And we wonder, how could that possibly be? And the answer is that when things get tough, investors make mistakes. The market marches on, and they're standing on the platform watching the train go by. Then they're buying in when it's high, and then they're selling when it's low. As a result, the average investor was better off sitting in treasuries over the last 30 years than taking the risks of the market and being invested in the S&P because they didn't stay the course. This chart is why I go to work every day, because as I tell my clients and I tell my prospective clients, anybody can go to Vanguard and buy the S&P 500. The problem is you have to have stamina, you have to have resilience, and you have to stay the course and know what to do during times like this. That's where your advisor comes in. This is why they get paid. So we're going to open it up to questions pretty quickly into this call because I want to hear what's on your mind. But I'm going to try to address over the course of the next hour the kinds of questions that I'm hearing from my clients, but more so from people that are not my clients. 90% of my clients lived through the 2008 crisis with me. And I've always found it's most advantageous to teach people what they need to know and how they need to think before a crisis hits. And it's been remarkable, Joel will tell you, that we've gotten so few phone calls of clients that were panicking or clients that were trying to do something that would hurt them, because most of my clients already know how to think through a crisis like this. But I have what I call many, many mitzvah clients, people who call me for advice, who don't meet my minimums, and I see the difference. It's quite stark. So I'd like to address over the course of the hour some of the questions that I've been hearing and the kinds of conversations I've been having, but more importantly, what's on your mind and what you'd like to talk about. But before that, let me just give you a quick backdrop of what's happened over the last 8 weeks or so, give you some color on it quickly, and then we'll open it up to questions. So Bill, throw up chart 2, please. Excellent. Okay, I can't see it. Let me just move this. Here we go. Okay. So the market went from an all-time high. The market that I'm using now for the remainder is going to be the S&P 500, but it isn't much different for any other market. And the S&P 500, for those that don't know, is simply the 500 largest stocks in the United States. So the S&P 500 on the far right of the chart hit its all-time high of 3386 on February 19th, 2020. And then it proceeded to drop until April 30th, 2020. Dropped is a total of 32 or 34%. It then recovered, as you can see, and ends down 14% from its high. Okay? From the beginning of the year, if you didn't start from the highest point of the S&P, the S&P is down now slightly less than 10%. So the question that I've been hearing from everybody, and Matt, before you came on the call, is how is this even possible? How could we be in the worst pandemic of modern day history, where unemployment numbers are reaching levels we didn't even think about in 2008, where the Fed has pumped now what amounts to 1/3 of GDP in stimulus into the economy, and we know that most states are, for the most part, shuttered, and we don't even know how bad it's going to be. Yet, if you just looked at the market, you saw that things aren't that bad at all, which is quite astonishing, and this is something that people have been asking me a lot about. But be as it may, in the middle, we take a look at the valuation of the market, and I'm not going to go into all the details, but the market actually isn't all that cheap at all right now. It's trading about 20 times forward earnings, which, jump to the next chart, Bill. You can see on the far right is actually above average. The forward PDE, forward price to earning multiple of the S&P over the last 25 years has been 16.35. We now find ourselves with a forward PDE of 20, which is astonishing that on the surface, the market is overpriced in a crisis that we find ourselves in. Now, those that are familiar with PE multiples and all that, when we say the word forward to PE, that means that we think that we know what earnings are going to look like over the next 2 to 3 quarters. And that in itself is a misnomer, because if you're listening to corporate earnings and you're listening to forecasts right now, the companies themselves don't have a clue. Yet the arrogant analysts on Wall Street claim to think that they know what the price to earning multiple forward looking on the S&P is. So there's always that chance that they got it wrong. They may have gotten it wrong and undershot. They may have gotten it wrong and overshot. The point is that information today is extremely murky, which is another risk we need to contend with. Just throw up the next chart, Bill. Thank you. This is a confusing chart, but I'm going to just make a couple of points on it. It's a great chart. If you could just focus on the left side of the page where it says YTD. And all I'm going to take you through is that column and the top column, which tells you the sectors. So on the far right, you see that the S&P as of April 30th was down 9.3%. Now, what's interesting about this sell-off is that it's an extremely lopsided sell-off. It's not like every company in the S&P went down 9.3%, obviously. So on the far left, you can see energy down about 36, financials down about 25, materials 15, industrials 20. So all those plus real estate have gone down more than the market. Things like consumer discretionary, technology, which has done even better since April 30th, communication services, which is a new sector that was added to the S&P recently. It includes the Googles of the world and the Facebooks. Healthcare, consumer staples have held up extremely well. So this has not been an indiscriminate sell-off by any stretch of the imagination. This has actually been a quite discriminate sell-off. There's been a rational approach to this sell-off. It hasn't been a pure flight to safety, which is actually a good thing. This isn't just we're going to dump the baby out with the bathwater. This is, I don't like energy because airlines aren't flying and the roads are empty. I don't like financials because people aren't paying rent, which means mortgages aren't going to be paid. Interest rates are falling through the floor. So that makes total sense. Banks are going to have compressed earnings. I don't like materials because everything is slowing down. Commodities are being lost less. Industries are slow, so industrials are slow. But I really like consumer discretionary because guess what? We can't even buy toilet paper here in New York. So we're buying up Clorox and toilet paper like crazy. Things are moving to the internet. And this is why the Googles and the Amazons are making all-time highs. Real estate's going to get hit, but healthcare, hey, more sick people, ultimately, more worries, more vaccines. These are all good things. So you can see that there's been some rationale to this sell-off. That's important, and I'm going to talk about why in a minute. So one point I'd like to make in general is that there's a big takeaway from this. The takeaway is that the market, whenever we think about the market, especially the S&P, or even broader than that, you look at the entire stock market. We have to realize is that ultimately, when you're diversified and you own a large enough segment of the market, you will always be owning the winners. There are always going to be winners. There are always going to be beneficiaries, even in a crisis. Because consumerism continues and capitalism continues. Because the world goes on and it doesn't come to an end, even with something like this, habits change, buying patterns change, demographics change, but change simply means somebody loses and somebody wins. And this is what you're seeing on this chart. People have quickly repriced what's going to be the new world after this. So I'll give you an example, a stock that's a favorite of Matt and I. We talk about it sometimes. It's an interesting stock. Not that I'm making a recommendation, but it's just indicative of what's changing in the world. So you look at a company like Amazon or Shopify or a Microsoft or any of these companies that facilitate online commerce, you realize that now there's an entirely new opening for them. There's a new world that opened for them because the consumer has become, many consumers have now adopted online purchasing, not out of choice, but out of necessity. But even more so, average storekeepers now realize that it's possible for another, God forbid, scenario where their store has to stay shuttered and they have to figure out how to pay their rent. And they realized that they were caught flat-footed in this environment because they had no online presence. Case in point, I went to pick up something last night from the pharmacy, and I spoke to the pharmacist, and he was telling me how slow things are for him. And I showed him CVS's earnings, which were remarkable. And I said, you need to understand the difference between you and CVS. You see, CVS was preparing for something like this for years. You guys have to start thinking about what the next one might look like. So those are some of the takeaways. The biggest takeaway for me is that if you look at the S&P 500 from January of 2019 until today, you have had a remarkable 12% plus annualized return. Whether there was a coronavirus or whether there wasn't, the market was due for a correction because markets don't go up 33% a year. Last year gave us 2 years or 3 years worth of return is the way we should think about it. As of this moment, we've given back only a fraction of that. If you look at the period from January of last year to now, you have had a remarkable run, the S&P 500. And if we would do this every 14 or 16 months, the S&P would outperform its long-term averages. So those are some of the points I wanted to make. Anybody who tells you that they know what's going to play out now is a liar. If I look at JP Morgan reports, or if I look at Goldman Sachs reports, or I look at anybody else's reports, or you look online, nobody has a clue. The market is no different than Corona. Nobody knows anything about the virus yet. They have no idea whether we'll come back or won't come back. We are immune, we're not immune. There will be a vaccine by the end of the year. The news is all over the place. And since that's what's driving it, how can anybody profess to say the market's going to take another dip, the market's not going to take another dip, this is overblown, this is that? We have seen in the last 3 weeks a market recovery that was unpredicted, unexpected, and people, even Warren Buffett's of the world, are sitting and scratching their heads and saying, how could it be? How could the market not be down 30, 40, 50, 60%, which is what people were predicting? So the answer is, it's going to happen. It's still going to happen. We haven't a clue. But just because we haven't a clue doesn't mean that there isn't things you should be doing right now. You look at this market recovery, if you stayed in and you stayed invested, and if you didn't, we can talk about that, and you look at it as a gift from God. And this is a time, if you weren't properly allocated, to sit back with your financial advisor and make sure you are properly allocated. So I'm going to give you a couple of pointers. Pointer number 1, you must know what you own and why you own it. If there's another leg down, it may be indiscriminate. The first leg happened really quickly, and people discriminately sold and then bought back. The second leg may be very different. People may be worn down. Many retail investors did not have a chance to sell before the market recovered. If, God forbid, there is another sell-off, it may not look like the chart we're looking at now. People may dump the baby with the bathwater. I'm just telling you that may happen. I'm not saying it will. I hope it doesn't. But if it does, you'll at least know Mark said it's going to happen. And I'm also going to tell you, ultimately, it's going to be fine. The important thing in these types of environments is that you have to have conviction. You have to have conviction that this is a stock, or this is a market, or this is a portfolio that I understand and I want to hold on to. I see this in every crisis. The people that dump their stocks and hurt themselves, dump them because they don't know what they own and why they own it. I have a hard, fast rule. I do not own anything that I wouldn't buy more of if it fell. This is the way Warren Buffett thinks about his stock portfolio. As he once said, he would pay 25% to see all of his stocks fall by 50%. He knows the value of these companies. He knows why he owns them. And if he can buy them on sale, he's willing to pay for that opportunity. He doesn't get flustered when one of his biggest holdings like Apple or JP Morgan dives 20, 30%, because he says this is a chance to buy it at a lower multiple. So you must know what you own and why you own it. And this is especially true right now for fixed income or bonds. Bonds were not spared this sell-off by any stretch of the imagination. In fact, Matt knows that early on, we made massive changes to our bond portfolios because I saw a crisis coming in liquidity and corporate downgrades, and I didn't want to own bonds, in many bonds in that environment. So understand your portfolio. Have a conversation with your advisor. Ask them what you own. Understand why you own it. If you're getting mumbo jumbo and you don't understand how the portfolio works or what this holding is there to do, the answer is sell it. Buy something you understand. You're going to need conviction. Second, have enough cash. This is an opportunity, if you didn't have enough cash, to raise it. Raise cash and focus on that cash. In 2008, when the world was crashing, I went back to school and I became proficient at something called behavioral finance. I ultimately taught it for many years at NYU, and it is how I get my clients through these types of crises. In periods like this, we would make use of something called mental accounting. Mental accounting is, instead of looking at your portfolio as a whole, you look at it in segments. You focus on segments of your portfolio, and in your mind, you bifurcate them. Meaning, you should have between 1 and 2 years worth of cash, especially if you are spending off your portfolio. Cash today should be pure cash. No duration, no credit risk. Don't try to be smart and pick up 20, 30 basis points because they gave you some gimmicky product that's going to take some commercial paper risk. You want to know that your money is rock solid safe. You have to understand, as we said, what your bonds consist of, and then you have your equities. In your mind, you should be labeling these 3 buckets as follows. Cash is all I think about right now. I have 1 to 2 years worth of spending. This is my piggy bank, or in Yiddish we call it our knippel. This is how I'm going to get through this crisis. I'm going to disassociate myself with my stocks. My stocks will recover. I know what I own. I know why I own it. And I don't know how this is going to work itself out, but we all know that it will. Human beings survive. We are a tenacious being. We will figure this out. God will help us. There will be vaccines. There will be remedies. Stores will open back up. Unemployment numbers will drop. It may take 6 months. It may take a year. It may take 2 years. I shouldn't care. I have my spending money off to the side. If it makes you feel better, set all your portfolios to accumulate cash, which means your stock dividends, your bond dividends should not be reinvested. They should be sweeping into your cash bucket so that as you're spending, you're getting some more cash. And this is the way you can disassociate yourself using mental accounting and say, I am not going to focus on everything else. This doesn't preclude you from understanding everything else, but it does take off the daily stresses. Second, I know this is going to sound crazy to some of you. Don't look. Every time you look at your portfolio, you run the risk of making a mistake you're going to regret. Daily moves mean nothing. We just had the most beautiful holiday of Pesach. And during that period, I couldn't look at anything. I just couldn't look. I don't check my phones. I don't check my emails. And the beauty of it is Pesach started with a 3-day. So it was a Thursday, a Friday, and a Saturday. So I open up my screen on Sunday, of course, because it's Saturday night, and I see the market's almost nowhere different than it was on Thursday. And I go back and I look, well, one day it dropped 2.5%, one day it rose 2.5%. And guess what? To me, it was all the same. It's going to be true if you look over a month, 2 months, 3 months, 4 months. Disassociating yourself from the daily volatility swings, not looking at your monthly statements in a month where you know it was brutal. I do not check my account balances when the market goes down. I don't want to know. It's going to give me the urge to do something. If you have enough cash, if you have enough safe bonds, you shouldn't care what your stocks are worth today, tomorrow, next week, or next month. In fact, there's a common study where they look at average, remember that Dalbar study of 4%? Well, there were actually differences between some investors and the others. Some did much better and some did much worse. Some did less than 4% because 4% was an average. Some did much better than 4%. One of the key differences between those that did well and those that did not was the frequency with which they checked their accounts. Clients that looked at their accounts, or investors look at their accounts quarterly versus monthly, did better. And people that don't look at their accounts even quarterly did even better than that. Remember, if you know what you own and you have conviction, then you should be able to ignore your portfolio. That's the key, because what you buy is and should always be long-term. Stocks are long-term investments. So COVID will pass. Many companies will unfortunately go bankrupt. Losses will be taken on debt, and real estate will remain vacant for some time. We may not rebuild the malls the way they were. There may be empty malls. There may be some bankruptcies. There may be some shopping centers that we no longer go to because their anchor tenant has gone away. The airlines, some will survive, some may not. There may be some bailouts. Energy, which was a second crisis within the crisis, will survive because we need oil, but there too, there will be great dislocations for a while. There will be winners as well. The economy will recover. Nobody knows when, and nobody knows exactly how it's going to look. But we're starting to see the signs of it. The unemployment numbers are leveling off, and we're starting to see all of the stimulus that is being thrown into the economy make its way into the system, bringing liquidity and buying power to the consumer of the United States, which is ultimately what drives the markets. So I am an eternal optimist, but I'm also an eternal realist. This is a time to be realistic. This is not a time to allow either fear or greed to drive investment decisions. When you are in a state of rationality, when you're in a state of equilibrium, you will make good decisions. And good decisions are ultimately profitable decisions. Don't jump on any bandwagons and don't jump off any bandwagons. Try to stay calm, speak things over with people that are rational. And ultimately, I believe this will prove to be a very profitable experience for all of us. And now, please, we'll open it up to questions. So I guess email them to Bill.
If I may, I'll just make a comment. What Mark was just talking about is not something he's come to recently. Like I said, I met Mark maybe it's 13 or 14 years ago. And about that time, maybe it was 10 or so years ago, we used to put on programs to talk about Jewish National Fund. Mark was the speaker, and he spoke on the psychology of investing, as he was talking about. So he shared, I don't remember all the details, but it stuck in my mind. He shared a story with me right before or maybe right after or before the financial crisis, that in the prior 10 years, the number one mutual fund over that 10 years, let's say averaged 12% a year. I'm throwing out numbers. The average investor, I don't know if you remember the name of the fund, Mark, the
Yep.
average investor
No,
in that fund over 12 years that made 12% lost money.
that's right.
And the difference was exactly what Mark was saying in the buy, panicking and being exuberant at exactly the wrong time.
So the fund, it was called the Excelsior Fund. Excelsior Fund had a positive return that was above the market, and their average investor lost money.
Right.
And I have two rabbis in investing. One is Rabbi Warren Buffett,
Right.
and the second one is Rabbi Sanford C. Bernstein, a
Right.
firm I was formerly a partner in. Sandy used to say that one day your clients will not thank you if you earn them money, but you cause them to puke 3 or 4 times along the way. So if you take a person on a roller coaster ride that they can't handle, even if they stay the course, they won't thank you when they get off the ride. What these types of funds did was they created so much volatility that the investors couldn't hold on for the ride. And therefore, you see, people say to me, let's buy energy, let's buy energy. And I had a few people who called me last week from my mitzvah clients, and I said, if you can handle another 60% drop from where you are today, then buy energy and don't look. And they said, you think it's going to fall another 60%? I said, very possibly. We can have negative oil. And they said, negative oil is impossible. I said, you're wrong. 2 weeks later, we hit negative oil and the 60-70% drop. And then they were calling and crying, Mommy, what do I do now? They couldn't handle the volatility. So you always have to think about volatility. Volatility is huge. And this is what behavioral finance teaches you. You gotta stay with it. If you can't envision sticking with it in the worst of times, don't dare buy it in the best of times.
Bill, we have some questions. Go. You're muted.
I'm going to do some questions.
Go ahead.
Hang on one sec. So we have a bunch of questions. Is the market today removed from the economic reality of high unemployment status and the crisis?
The answer is without a question, it's removed. You can see the market's pricing a fairly decent, forecast. But the question you ask yourself is, are they all drunk? Are they insane? Remember, the market is a voting booth of millions of people. So have millions of investors gone insane at the same time in a period where we would think herd mentality goes the other way, right? So popular wisdom always says there's got to be something wrong, right? So we can say, we call this thing Wall Street, as the client yesterday said to me, Wall Street has gone mad. And I say to my client, fine, so would you like to sell all your stocks? And she says, well, I don't know. I mean, it's going really well. But I said, but you're part of Wall Street. So are you saying that you've gone mad? So the answer is we have to stop and say, what might me be missing? Because if it was so apparent that Wall Street has this wrong, the market would go down, right? I always say to clients, what do you know that all the millions of investors don't know? They're watching the news. They're reading the reports. They're seeing the numbers. So we have to we do run the risk that Wall Street has gotten ahead of itself. And when reality actually starts to play out, and what would reality be? The true effects of this start showing up in corporate earnings. That's when Wall Street takes notice. When we start to read about bankruptcies and downgrades, there is a good degree of chance that the market's going to reprice and sell off again. There's also a God forbid chance that this thing comes back again sometime in the early fall, and we go through the same thing again. But you cannot put that 100%. People are putting that probability at 100% and saying, the market's insane, I'm getting out when I can, and I'm going to sit it out. And they did this last week, Wednesday and Thursday and Friday. We had some weakness in the market. I got at least 10 emails from people who said to me, the next bear market has finally begun. And here we are, string after string of up days, and they're sitting and scratching their heads. So let me give you a couple of things. So we always want to counter, right? Whenever we feel extremely negative, this is another behavioral finance idea, we want to counter it with countering information. So let me give you a few counters to that. One, in history, if you go back and look at markets and you knew nothing about what was going on in the headlines and you only followed the following things: stimulus and low interest rates. Just ignore everything else. When you see stimulus and low interest rates, it may not be today, it may not be tomorrow. If you put your money into the market, shut yourself up, went into a submarine and went down for 2 years, came up and look at your portfolio, you did extraordinarily well. This is what the market is focusing on. One, unprecedented stimulus. Insane what they're doing. All of this liquidity ends up someplace. Where can it go? Two, what am I going to buy? Treasuries, which give me after taxes almost zero. I don't particularly like fixed income. Interesting statistic. Investors pulled the last quarter far more money out of fixed income than they did out of stocks. In fact, they pulled more money out of fixed income in the last year to date than they did during the crisis of 2008. Investors put that money into the stock market or cash. Investors are basically saying now, I don't like bonds. Munis have their risks, taxables of theirs. So I have a choice. Earn nothing in cash, or do I go the other way? Question somebody else says, am I saying that stocks are safer than bonds? No, but they are more profitable to people who have long-term perspectives and say, it doesn't make sense to own some of these bonds in the yields they're giving me. If I'm going to take risk, I may as well go into the stock market. I'll give you another case in point. A few weeks ago, you could have bought baskets of healthcare stocks, solid, rock solid stocks, and you could have built yourself a portfolio averaging 7 to 8% dividends. It's insane. ExxonMobil, Chevron, Glaxo, AbbVie, Pfizer. You could have bought up a basket of stocks. These companies have more cash than the US government, and you just sit back and clip your coupons. This is what investors are saying. This is what I said. This is not an indiscriminate sell-off. They're moving money to cash. Now, when money sits in cash, human beings ultimately are greedy. Never bet against greed. We stay in cash for so long, and then we get itchy to do something. So we have unprecedented stimulus, which is bringing liquidity into the markets. This liquidity ends up someplace. Low interest rates means that the competing investments, such as bonds and cash, cause people to want to do something. Next, I'm sorry to say, but this all weighs on the dollar. Client said to me yesterday, but the dollar is going to go to pot. Well, if the dollar goes to pot, assets go up in price. That's the reality. That the weaker the dollar, right, the less the currency is worth, the more assets appreciate to reflect that. So corporate earnings, because if you need more dollars to buy an Apple iPhone because the dollar is worth less, then Apple is going to take in more dollars. It also causes real estate to go up and other assets to appreciate. So if we have a projected period of lower interest rates and lots of cash sloshing around, this makes for an ultimate recovery, which may bring the markets to highs that we never expected. The market, or Wall Street or Main Street, whoever it is that you call it, is willing right now to look past the next quarter or two to write off corporate earnings, as abysmal as they may be, in anticipation of the aftermath. That doesn't mean they got it right, but it explains some of the rationale, and it also gives us some food for thought where it might actually not take the big dive that people are expecting. However, I caution you all, prepare for it, because there is a reasonable probability that it's going to come. It may not be as severe as the first one. It may be more, it may be less, but it may very well come. It may come in August, it could come in September. Sentiment changes very, very quickly. Don't be put off by that, because that's all it is. It's sentiment. It's not what we're focusing on. So this is not that astonishing in retrospect. If you would have asked me 3 weeks ago if we would be here, I would have said probably not. But in retrospect, it's not all that surprising.
Mark, thank you so much for that. I mean, all the information you've given us has been amazing. And we do have a few more questions, but briefly, Robin Dermer is just going to make a few comments. And I would like to mention that Mark handles many different accounts for us, and one of them is the donor advised fund account for Jewish National Fund.
So Mark, hang with, we're going to have Robin speak a little bit, and then
Sure.
have some more questions for you.
Sure.
Thank you. Go ahead.
Hi. Thank you, Mark, for your insight and your amazing ability to communicate it to all of us. Definitely learned a lot. As Cynthia mentioned, Jewish National Fund has a donor advised fund, which Mark and his team run the investments in the fund. For those of you who don't know what a donor advised fund is, it's basically a charitable savings account. When you put money into your donor advised fund, you receive a deduction for the full amount the day that you make the donation, and then you're able to issue grants to your favorite charities, including Jewish National Fund, over the life of the donor advised fund. A Jewish National Fund donor advised fund begins at $10,000, but you don't have to take it out in the given year that you establish it. You have your choice of investments and investment strategies. You can pick up to 3 investment strategies. Is that correct?
Yes.
Matt?
3 out of 6.
3 out of 6.
Right.
When you're invested. The benefit of it is that you're able to allow your charitable dollars to be growing while you're contributing to organizations. The Jewish National Fund charges a 25 basis points fee, administrative fee, which is one of the lowest out there. And all we ask is that you grant 15% of the overall value of the fund to a Jewish National Fund program or project. Do we have another slide? It's very easy to set up. You can do it online, and you can manage it, from the comfort of your computer and your home. It's very easy to, if you're watching it often, you can check in 24/7, although Mark would suggest you probably don't check in that often. But it's very easy to follow, and you've got the backing of Jewish National Fund and our team if you have any questions or need any assistance making any grants. One of the benefits of a donor advised fund is it allows you to collaborate and talk with family members. Perhaps you want to set something up for your children or your grandchildren to get them used to giving. It's a way to open the conversation and a way to save on your taxes when you're making that initial grant.
So we do have many more questions, but does anybody have any questions for Robin? You can post them in the chat area if you do.
I'm going to jump in quickly. Robin, remind me of something. I'm going to give a plug for next week's Zoom. One of the outcomes of all the stimulus is likely going to be higher taxes. Shocking. If we do have a Democratic president in the office, that would be another reason. You all know, those of you that are in the estate tax regime still, you have assets that are over 11 or 12 million. If you're in states that have lower numbers than that, all that is due to sunset in 2025, but there's a good chance, given what's going on here, that that's going to be changed sooner. So any of you who are in need of estate planning or wealth transfer strategies, I would pay attention to next week's call, because this might be the time to start doing something about it. The other reason is that giving away assets in a depressed market is always a good idea. So I urge you to tune in next week. I saw the next week's speaker. She's a great speaker, great attorney, and you're going to learn a lot. Okay, sorry, back, Cynthia.
Thanks, Mark. So we've had a lot of questions about index funds and then incorporating bonds or fixed income into your portfolio, especially in light of the low interest rates.
Right. So it's no secret that I am a passive investor. I am a student of the Warren Buffetts of the world. I grew up in finance in a firm which was purely what we call active management, and quickly realized that active management, and I'm fine saying this on a Zoom call, is going to one day be a dinosaur. It's expensive and it often underperforms. When we talk about conviction, okay, this is the key. When you buy individual stocks, if you have time to research these stocks, follow them, read their earnings reports, look at competition, and do all the work that analysts do and often get wrong, I will add, then by all means, take some money and play with your stocks. The problem with stocks, individuals, is not buying, but selling. Buy disciplines are easy. Sell disciplines are very difficult. So when you look at managers that manage individual stocks, what they tend to do is buy well and sell unwell. They sell stocks after they've taken a big fall, and they fall in love with their stocks. The average manager, I'm not an average manager, 85% of managers underperform the S&P. They're taking more risk, they're creating taxes, they're charging higher fees, and 85% of them underperform. So the best bet for most people is simply buy the index and leave it at that. You're not going to beat this index. It's very tax efficient. Now, let me tell you where the conviction comes from. There is no greater conviction in my mind than owning the entire S&P 500. What you are betting on is the continuity of capitalism. The world continues. In that index is every single sector, every company of that sector. So you own healthcare, you own pharmaceuticals, you own biotech, you own consumer discretionary. You don't have to be a wise guy. You just know that you are buying the continuity of capitalism. If you go back to the chart, Bill, throw up chart 1 that we didn't show. This is a very important point. That is the S&P 500 since 1900. And I didn't get the answer to this, but I'm pretty sure I'm right. That does not include dividends. It's just the price of the S&P 500. Now, what you're going to notice is that we had a really bad period, right? Going, let's ignore the early 1900s because it doesn't even represent what the market is today. But you look at the Great Depression and you look at everything since the Great Depression. Now, the Great Depression was a period of 14 years where you got no returns. But since then, there's never been a 15-year period in the market where the market has not returned reasonable returns. You see an upward slope, and you see a lot of raggedness, ups and downs and ups and downs. And this is since it's so squished together, you don't really see how bad they are. But you can see the global financial crisis. You could see the market since then. You could see the tech boom. You could see the market since then. You could see Black Monday. You could see the Cold War. You could see the Vietnam War and everything in between. Now, the way I look at it is like this. I'm going to tell the story, Matt, that I told the last time we were together. When I was a little kid, my father used to have this custom. Every morning he would listen to the radio, and there was this guy who some of you probably remember. His name was Larry Wachtel. Bacon, Halsey, Stewart, Shields. When Larry Wachtel came on the radio, it was as though Moses came down on Sinai and was speaking to the Jewish people. Everybody in the house had to be quiet because my father had to hear every word he said. And I remember as a little boy hearing, market went up, market went down, market went up, market went down. Every day was up, it was down. And it sounded really weird to me. Like, what does this thing do? Does it go up? Does it go down? And my father and I had a conversation. I asked my dad, I said, Daddy, what does the market ultimately do? Does it go up? Does it go down? Does it go up, go down? And my father said, son, it goes up. And I said, Father, why? And my father said, son, I have no clue. One day I'll put you through college and you'll tell me why. I look at this chart and I know with certainty that as long as we're alive and breathing, 30 years from now, 20 years from now, 15 years from now, this will continue to look like it does. It will be jagged, it will have ups and downs, but it will be upward sloping, as you can see. And the reason is because the things that drive the market as a whole are present and will always be present. And they are inflation, gross GDP growth, which is population growth, and ingenuity. So when you buy an index, if it's the S&P, if it's the total index of US, if it's the world index, what you are buying is population growth, GDP growth, and the world's combined ingenuity. With the falling values of currencies around the world, as governments continue to overspend, all that ultimately falls into the bottom line of corporations. Long term, there has been no greater asset creator than the market. So when you study the market, you study what drives it, you understand its underlying fundamentals, and you say, yes, there will be losers. Yes, some airlines may die and fall out of the S&P. Other companies will take their place. But when you own the entire breadth of the market, no one company or two companies ultimately matter. And you don't need to be extremely smart, and you don't need to sit and look at your screen all day, and you don't need to study stock charts and corporate earnings reports. So I'm a big fan of passive investing. Warren Buffett himself says it. Read John Bogle's books. This is the way to think about it. When it comes to fixed income, it's not so simple. It's really not so simple. Stocks are far simpler than bonds. Bonds are very, very complex. The bond market itself consists of thousands and thousands of different issuers and different types of bonds with different types of credits. What's important for you to know is that risk should be taken in the stock market, not in the bond market. You don't own bonds to squeeze out another 1-2%. People learned this the hard way in 2008 with auction rate securities when they found out they can't get their money back, or when the commercial paper markets froze up. What you own should be rock solid safe. If you own municipal bonds, don't try to be smart and have somebody sell you a 4, 5, 6% yielding Airport bond or a revenue-backed bond with some small municipality that can have a downgrade tomorrow afternoon on their credit. If you want to take risk, buy the stock market. Make sure that you own safe, liquid bonds. This is not a time to take crazy risk. If you own corporate bonds, stick to high grades. If you own government securities, great. Mortgage-backed securities, anything that is rock solid will do fine. It may go up, it may go down a little bit, but as long as you know at the end of the duration, there's an issuer that can pay their bills, you'll be okay. Bonds are going to give you better returns than cash, but they are going to introduce potentially more volatility over the next year or two, and you have to be prepared for that. And that's why you have to have that cash cushion even before your bond portfolios.
Mark, thank
I
you.
just want to add, I just received a question that may apply to some other people as well. And that was whether or not you can use IRA funds to establish a donor advised fund. And the answer is no. You cannot use your IRA to fund a donor advised fund. And then the second question was about transferring if you already have an existing donor advised fund. And the answer is yes, you can transfer it. There are no fees or tax consequences to transfer it to Jewish National Fund donor advised fund.
So, Robin,
Sorry,
let
Bill.
me just add something to that because it's a great question now. Then we'll bring this session to a close. The IRA question is you can't use IRA money directly from your IRA to your donor advised fund. That is the law. However, if you took money out of your IRA, recognized the income because you're taxed when you do that, and put the money into the donor advised fund, that you could do, and the offsetting deduction, the deduction you get should offset the great majority of the tax you might have to recognize when taking the money out. So Robin is 100% true. You can't take money out of your IRA and put it into the donor advised fund. You can take money out of the IRA yourself, recognize the income, make the contribution to the donor advised fund, take the deduction at that time. Just a point of clarification. Mark.
Somebody asked a question on the chat that I think is important to address. And I'm happy to stay on the chat if anybody has other questions.
Okay.
And if not, Matt, you can give everybody my email address and anybody can ask me a question. Somebody's telling me that their broker is telling them not to give away stocks as a charitable gift right now and to use cash instead because we're in a depressed market. That makes zero sense. And in case anybody else is hearing this kind of advice, it sounds ridiculous. It never makes sense to give cash as a charitable donation if you are a stock holder, unless every stock you have is underwater and you only have losses in your account, in which case you need to rethink who's managing your money. It always makes sense to give away appreciated stock. All things being equal, you get a full deduction and you never pay capital gains on that appreciation. If you have a stock that was up 75% and now is only down 20%, which may be what's driving this advisor's advice, and he's thinking the stock's going to recover, wonderful. Give away the appreciated stock of 25% and then just buy it right back. It doesn't make any sense to give cash. So unless the stock is at a loss, it's a great candidate for a donation. Give away your most highly appreciated stocks, and if you love them, buy some back.
So Mark can be reached through email at mark.horowitz@jpmorgan.com.